very warm welcome to this session on Hong Kong, Asia's premier asset and wealth management center. And we, the Financial Services Development Council, is delighted to hold this panel discussion. Established in January 2013 as a cross-sectoral government advisory body, the FSDC has been engaging the industry and stakeholders in Hong Kong with a view to formulating proposal to the government to promote and the further development of Hong Kong's financial services industry and map out the strategic direction for our development. The FSDC comprises over 50 members who are broadly representative of various subsectors in the industry, has been studying the potential of asset management and related business with keen interest. Among our 10 reports so far released to the government, 3 of them cover these business. This afternoon, we have assembled a panel of experts covering traditional and alternative asset management, banking and trustee services to introduce Hong Kong's asset and wealth management industry to our distinguished audience. But let me first take a few minutes to talk about Hong Kong's value proposition as an asset and wealth management center, namely as an international platform with unique access to investment markets in mainland China. Hong Kong's combined fund management business at the end of 2013 was over $2 trillion, up 27% from a year earlier, and which was another record. Hong Kong is the largest asset management in Asia, excluding Australia, with assets under management almost equivalent to those of Japan and Singapore combined. But Hong Kong's value proposition is more than just the gateway for China. We take pride in being a platform that attracts capital from investors around the world and connects the fund with opportunities in mainland China as well as regionally and globally. Asset management business is no exception in this regard. Overseas investors amounted to about 70% of our fund management business, and close to 50% of the assets were placed outside mainland China and the Hong Kong markets, with a fairly balanced split between Asia-Pacific and the Western markets. All these support our position as an international asset management center with both regional and global footprint. While Hong Kong has been successful as a portfolio management as well as sales and marketing center in Asia, we will further consolidate our position as Asia's premier asset and wealth management hub. In particular, we will leverage our core competence in legal, accounting, and trustee services in order to expand into new areas of potentials. Fund domiciliation business is one of the major components in the asset management value chain, and Hong Kong is looking to nurture this area. Developing a framework for the mutual recognition of funds between mainland China and Hong Kong, introducing an open-ended fund companies regime and funds, and and extending profit tax exemption to offshore private equity funds are some of the initiatives for us to grow origination and manufacturing of funds. Our panel experts will share more on these measures. With our strong international dimension and a one country, two system principle, under which our internationally recognized legal system is allowed to remain after 1997 reunification, Hong Kong is the testing ground for the opening up of mainland China's financial system. At the same time, our platform offers unparalleled access to the mainland investment markets. Let me just cite a couple of examples. Earlier, just now, this afternoon, you heard from the previous panel about the role of Hong Kong in the internationalization of renminbi. The Renminbi Qualified Foreign Institution Investor Scheme, the RQFII, launched in 2011, provided a total quota of 270 billion renminbi for both the Chinese and non-Chinese financial institutions to develop renminbi-denominated products that place clients' funds into mainland China's equity and bond markets. This is one example. And second, the Shanghai Hong Kong Stock Connect program, when launched, will give Hong Kong and international investor access to some 500 shares listed on the Shanghai Stock Exchange without the need to apply for quotas from Chinese authorities. You've heard about the Stock Connect just now, also in the previous session. And our members on the panel will also expand onto this. After this Stock Connect scheme is put in place, overseas investors will be able to invest directly in shares listed on the mainland stock market up to an aggregate cap of 300 billion renminbi. The Chinese authorities are prepared to provide such arrangement to Hong Kong because these arrangements are mutually beneficial to both the mainland China and the Hong Kong markets. For the mainland domestic markets, we will see increased participation from overseas investors and will provide impetus to the growth of renminbi as an asset class. For Hong Kong, our position as the hub of renminbi products will be further consolidated through enhancing the cross-border use and circulation of renminbi funds between mainland China and Hong Kong. Ladies and gentlemen, no speech today on Hong Kong can avoid talking about the latest Occupy movement in Hong Kong. The ongoing student protests on the street over the past month has certainly attracted international attention. I'm glad to say that there are now signs that the movement is winding and perhaps will come to an end fairly soon. There are smaller crowds on the street, and although there are still some key trunk roads being blocked, there's no question that some of our daily life has been inconvenienced. But we have also heard the voices of the students. But thanks to our dedicated police force, there have been no serious injury arising from the protests, nor were there any looting or vandalized shop fronts or overturned vehicles, as we've seen elsewhere when similar movement took place. But the important thing for us to share with you is that our stock market, our foreign exchange market, and our financial system have continued to function normally and are in good order. Our stock market index dropped after an initial 2 days drop, has now recovered and was pretty much the same as what was a month ago. Similarly are the trading volume. Financial institutions in Hong Kong, being naturally prudent, have drawn up contingency plan to guard against operational disruption. And thankfully, largely, we did not have to utilize any of these. And an overwhelming majority reported that the business in Hong Kong are conducting as usual over the past month. In essence, we are open for business and will continue to provide value through a regulatory regime which is aligned with major global markets, the rule of law, and the flow of information and capital. We have robust infrastructure and a rich pool of professional talents. Our role as the testing ground for mainland China's financial market reform will not be changed, as the process has been and will continue to be mutually beneficial to both the mainland market and the Hong Kong market. We are hopeful that the issues being expressed on the streets now will be resolved through rational exchange of views among stakeholders. And finally, coming to the theme of today's conference and the theme of our panel, I'm delighted to pass the floor to Mr. Mark McComb, one of the members of FSDC, and who is currently the Global Head of Institution Client Business and Chairman of Alternatives of BlackRock. Mark, please. Thank you.
Thank you very much for all coming along this afternoon. I think we have a wonderful panel here for you today. Very conscious that it's late in the day and it's probably this panel standing between you and a well-deserved drink, but it's very much appreciated. And actually, I think the topics that we're going to discuss today are amongst some of the most interesting that are facing Hong Kong as we go forward into this next period of evolution of the internationalization of the renminbi and the liberalization of the Greater China market. Now, what we've done this afternoon is to try to liven things up a little bit in the discussion. We've asked each of the panel members to take a particular angle and look through a particular lens on the subject of wealth management within the Greater Hong Kong area. And why do I think it's important that you get a full color this afternoon is really because there are many aspects associated with the development of Hong Kong as a financial center, which are very closely tied in not just to the liberalization in China, but some really important macro themes that are spreading across not just Asia, but the rest of the world. So we've heard a lot of people talking about the fact that the rising middle class in Asia is one of the most interesting and unique opportunities for investment management companies to leverage. And we also know, of course, that in a world where low interest rates appear to be with us for the long term, increasingly end investors are looking to find new opportunities to seek returns and seek alpha. And this means that they're seeking far and wide to find the right returns. And this, of course, presents a great deal of opportunity. Added to which, of course, Hong Kong has always occupied a very central position in terms of its strengths as a financial center, its very proactive and laissez-faire approach to business, and also its very benign and business-supportive regulatory environment. But I think what you'll hear from some of our panelists today is that Hong Kong needs to keep running to stand still, because there are many competitors out there, many markets that are rising that are going to take on Hong Kong as a competitor. And I think what we're here today to talk to you about is really why the competitive advantages that Hong Kong has and its position, not just in the region but also globally, is something which is very important, very critical, and should still be a major driver of investment into the region.
We've been on the ground in Hong Kong, for example, for 32 years. And the investment teams were established in 1982. Actually, Asia is today is our second home market, with 1,000 people across the region. And specifically in Hong Kong and mainland China, we've got basically three axes at work. One, historically speaking, was basically to service onshore clients with offshore investment strategies, and this is the bulk of the assets today, and more to come with QDI. The second axis was to service onshore clients with onshore products throughout the joint ventures, joint venturing with ABC in Shanghai. And the third promising and exciting area is this new wave of opening, including initiatives like QFE, RQFE, the Hong Kong Shanghai Stock Connect. And basically the idea is to provide offshore clients with access to Chinese markets and exposure to their RMB. So this is the idea, actually. And the simple message is get prepared. As an asset manager like us, it's a matter of practicalities, building, for example, investment teams on the ground, able to manage A shares for sure, RMB, offshore bonds, and probably more investment strategy going forward. We are European. We are in Asia. Our basic role is to recycle and channel reserves and savings along the Europe-Asian axis and elsewhere for sure. But this is basically our mission. This is why the opening of Hong Kong at the capital marketplace is key to us. Since all of the initiatives will probably lead to the build-up of various investment strategies in the bond space, in the ETF space, in the money market space, in the equity space, and so on. We've got to make sure that it's not only a matter of distribution, it's also a matter of production, building capabilities on the investment side, on the ground, and turning the project into a reality.
Right now, I think many of us are looking at Asia and understanding that the wealth management industry is a fantastically interesting one, and many firms, international firms, want to be in the business of providing mutual funds to retail clients. But we have to understand that really the concept of a mutual fund in Asia is still a relatively new one. 20 years ago, this was a fairly rare thing. And even today, if you look at penetration rates of mutual funds in people's portfolios, it's still single digits. It's probably just above 6%. You compare this with the US, where we're talking about, I think, above 35%. And I say quite often, and I think, I don't know where this quote came from, it might well have been from you, Mark, but Asians are great savers, but they're so far not been great investors. And so everybody's looking at how we can make these great savers use mutual funds as a tool to invest their money and get a better return on their savings, including the regulators, including the governments. So it's no surprise that with the growth in the market, and there's still fairly early days for mutual funds as a tool for savers, you see a lot of initiatives now around what's the best way for countries to provide access to mutual funds and to provide diversification in mutual funds. Now, the most open economies in Asia, Singapore, Hong Kong, Taiwan, as fairly early adopters have chosen the European UCITS as the way of doing this. And it's worked quite well. Asia is a high percentage of the offshore, of the non-European sales of UCITS, particularly through those three countries. But if you think this through, beyond those countries, really, UCITS haven't taken hold. And so you look at the big markets like Japan, Australia, China, India, it's local funds, local fund ranges that have been dominating the mutual fund industry. And as these markets grow and develop, of course, now governments started to think, well, how can we leverage on our markets? How can we leverage on our platforms? And how can we grow our asset management industry by making our platforms more universally accepted? And the first step, obviously, would be then to look to your direct neighbors. And that's exactly what's happening. Now, in a nutshell, there are three key initiatives in Asia that I think are worthwhile looking at, particularly if you're here in Europe and want to do more in Asia. And I'll start with two that are non-Hong Kong related, and obviously I'll spend a bit more time on the Hong Kong related one, given the fact that we're promoting Hong Kong here today. There's one government-sponsored one, there are two regulatory-sponsored ones. The government-sponsored one is one which is called the Asia Region Fund Passport, the ARFP, which is largely driven by Australia and has as the key participants now Australia, New Zealand, Singapore, and Korea. I think this is the initiative that eventually will be the closest to a fund passport. So it will be a true approach like the UCITS is in Europe, where you can use a single fund range across a number of countries. But this comes with a lot of complexity, and therefore, in my belief, it will take quite a while before this is actually up and running. But in a way, it's the most comprehensive approach. And there are two regulatory-driven ones, one in Southeast Asia, which is now called the ASEAN CIS, so a collective investment scheme, and then the mutual recognition that Mark was touching on. Now, the ASEAN one is really just a cooperation between Singapore, Malaysia, and Thailand to allow each other's funds to be sold in each other's markets. But it's not more than that. It's not a new fund range per se. It's just you wouldn't need further approval if you have a Singapore domiciled fund to get that sold to retail investors in Malaysia. And there's obviously some requirements around how you can do the sales process. But that in itself is what it's all about, and obviously vice versa, a Malaysian fund in Singapore and then Thailand as well. Then come to, I guess, the one we should focus on today, which is the Hong Kong-China mutual recognition. This initiative has been much talked about. It's been up and coming for probably over a year in terms of we know more or less what it's going to look like, but it's just not been announced yet. I think it's of key importance because it does fit in with many of the things we've heard this morning and this afternoon around the opening up of the capital markets in China and the internationalization of the renminbi, etc. It's another way for Hong Kong and China to work together and for them to grow their business, and in this case, obviously, in an area of wealth management. Not all details are known, but we do know that it's going to be a cooperation. I think a lot of it will be similar to some of the things you see now in Hong Kong Shanghai Connect in terms of the approach and the idea behind it. Now, what we do know, and I just wanted to read out a few things that we as a firm look at and why we're quite excited about it. We do know it will be based on mutuality and respect. So you're talking about ensuring that common rules and standards will apply. So that's one area to look at. It has to be a win-win situation for both sides. This is not just about Hong Kong-based asset managers' ability to sell into China. This is very much also by Chinese asset management companies who will be able to expand internationally and use Hong Kong as a platform to reach more international investors and reach global markets. And thirdly, it has to be measured, pragmatic, and conservative. And what this means is that you will see this develop over time. So you could look at this and take a fairly dim view in terms of what will the quotas be, what will the products will be allowed, what are the requirements around domicile, etc., in terms of where the money is managed. But see this as a first step in something that will grow, if managed successfully, into something very, very substantial. And so yes, the original products will be fairly simplistic and will be have a lot of requirements linked to them, but I think over time that will liberalize quite quickly. So I think mutual recognition shows again that Hong Kong has a unique position in being a conduit to link in with the strong growth in China in the wealth management market, and provide another platform next to working through RQFI, QFI, Stock Connect as asset managers to do so.
It's my honor to be here, and obviously I come from mainland China, and Laura just mentioned a lot about new development of RQFI, QFI, and also Shanghai Hong Kong Stock Connect. And for all this regime and all this program, we look at that. We cannot miss out the one big picture is the China is opening its capital market, and the speed is faster and faster. We can see that QFI was introduced in 2003, and RQFI was introduced in 2011, and for the past more than 10 years, the QFI, has granted like 62 billion US dollar, and the institution is like 266. And only 3 years, the RQFI, we have like 86 institutions. Most of the companies sitting here are RQFI institutions. And even dramatically, it's like Hong Kong, we have 270 billion RMB quota, and this quota is totally been granted last month, and we are expecting more quota. And I think Laura is doing a lot of work to persuade the central government to grant us more quota. And why we can, since going so fast, I think is because the interest of investing to China is huge. And for my point of view, my company was set up in 2008. We are the largest RQFI institutions. For the past 2 years, we raised 6 billion euros for the past 2 years, and our asset management, size increased dramatically. Cannot compare with BlackRock, although I think being an asset management company, asset manager in Hong Kong, I think there's a lot of advantage to being there. First of all, I think because Hong Kong, is part of China, and all the new program, the policy will be testing in Hong Kong, and we already witnessed that. Another thing is I think Hong Kong is a very open society, and also Hong Kong's government doing quite a good job to facilitate and to help the asset manager over there. I give you an example. It's like RQFI. People all know that RQFI is kind of very treasure the quota. Hong Kong already ran out of the quota, but Hong Kong government, they allow the asset manager like us to facilitate not only the Hong Kong product but also London, US. So really helping the Hong Kong local and also Hong Kong international firms to get a footprint all over the world, and to do to do better job if they find the specific market has opportunities. And last thing, I think to be in Hong Kong to doing business is good, is because the Chinese financial market is a little bit complexity. compare with the overseas, like the settlement cycle. you know, outside of the China, we all get used of the T+0, trading settlement cycle, and the T+2 normally is T+2 settlement. But in China, we like all doing like T+1 and don't even mention about the bond market. The bond market is very complex. If you try to launch a fixed income product, you probably need some local expertise. I think in Hong Kong, it's very easy for us to hiring talent people and to do the marketing globally. And last word is like I think companies should go to Hong Kong to do business, because once simple things you can think is like China is the second largest economy, and the GDP is count for 20% of the global GDP. And in this room, how many people you can see your own portfolio or your client's portfolio is even closer to 12%. So I think the business opportunity is huge. Yeah, thank you.
Banks play a very, very important role in the wealth and asset management food chain, because 80% of retail fund management business is being sold through banks. Let me make a statement here first. Asset management business is a good business to be in, because they keep all the economics. They leave very, very little commission to the banks. I sell BlackRock, I sell Schroeder, I sell Mundi. That's the rich side of the room. This is the poor end. But on a serious note, from the bank's perspective, let me comment on Hong Kong on two perspectives. One from a stock perspective, one on the flow perspective. First of all, from stock perspective, Hong Kong is very, very deep and rich in liquidity. If I were to add up all the banking sector's deposits, express that as a multiple of GDP, okay? US is about 0.6. So US deposits is 0.6 times of their annual GDP. France is 0.8. UK is about 1.2. The savers, let's say Japan, China, will be in the neighborhood of 1.5 times. Hong Kong, 4.3. It's very, very significant. If you express it in dollar terms, France in total has about 2 trillion of deposit US dollars. Hong Kong, a city of 7 million, has about 1.2. So very, very significant. Also, because the Asian mentality tends to be a little bit more conservative, they keep more in cash and as a deposit, as a form of wealth preservation. Hong Kong as a center is both rich in liquidity and also with very, very good upside potential to upsell. That's a stock of the Hong Kong market. Flow is also a very, very exciting angle, because Hong Kong is attracting a lot of regional wealth, and in particular mainland flow. If Hong Kong has about 1.2 trillion of excess deposits, China has 17 trillion. And a lot of the 17 trillion has very limited access to international fund management business. As a matter of fact, if you look at financial assets in China, only 3% are actually managed by the fund industry. So from that angle, then Hong Kong becomes a very, very attractive center for mainland wealth and a high net worth segment. We estimate that there are about 50,000 new high net worth or mass affluent segment coming to Hong Kong to open new accounts every year. And that number is growing. And you may ask, what sort of profile are they, this 50,000? If I look at the Hong Kong segment first, the Hong Kong segment, quite sophisticated. They roughly, most of them are professionals. Their average age, it's around 52. If you look at the mainland 50,000, they are the young, low 40s, about 41, 42 years of age. Most of them entrepreneurs. About a third of them from southern China, Shenzhen, Guangzhou. Another third comes from Shanghai, Beijing, and the other third comes from the rest of China. And they are telling us that they're happy to allocate 40% of their wealth offshore, and in particular into Hong Kong. So all I would say is really from a stock and a flow perspective, it's actually very, very exciting.
Mark asked me, why are you making a presentation? Presentation could be boring, but not when I make the presentation. So you'll see. Okay. We are very seldom in the limelight. It's usually the fund managers in the limelight. So for once, the trust industry will take this precious opportunity to have our say. Now, before I begin, Benjamin, banks are not at the poorest end of this whole thing. It's the trustees and administrators. We get the lowest margin, but the highest risk, because trustees bear fiduciary duties. So, but we're okay. We like our work. Hong Kong is known as a major asset management center. But the fact that it is also a major trust center is little known. Hong Kong actually, in terms of assets held in trust, and by trust industry, not, even roughly, we're talking about 2.6 trillion Hong Kong dollars. And the trust industry is very diverse. So if I do a short presentation, so I would just focus on two things. One is the trust law reform, and the second one is corporate trustee for the asset management industry. Okay? So let me talk about the trust law reform. Okay. The trust law in Hong Kong is based on the common law, English common law. The trustee ordinance has been in place since 1934. In view of the trust law reform in many, many jurisdictions, Hong Kong finally amended its trustee ordinance in 2013. For those who are also in wealth management industry, this will be useful information. As you help your clients in asset management, you can also help them on financial planning. Now, I only list out some of the key elements of the trust law reform. Reserve powers of the settlor. This is something new. It's a very important feature. So it reserves the investment and management of trust assets with the settlor. And perpetuity period of trust, there's no longer a fixed period. So you could have a perpetual trust for lifetime. And forced heirship protection. Some jurisdictions have forced heirship. Hong Kong have abolished it, so it's a Hong Kong trust. No foreign jurisdiction of forced heirship will affect its trust. And if to facilitate the administration of trusts, so the trustees are given more default powers. For example, in selection to custodians, nominees, etc. And as well as giving more protection to beneficiaries and settlors. One of them is putting the professional trustees like ourselves as a higher level of statutory duty of care. So when you trust, if you put your trust in your trustees, in the professional trustees, your assets are very well protected. And also their protection for additional, for beneficiaries as well as settlors, which I don't go into it because Mark will give me a dirty look. So now, and then also, this amendment had bolstered the competitiveness of Hong Kong and attract settlors to set up trust in Hong Kong. Actually, since December 2013 last year, dozens more new trust companies are set up in Hong Kong. More trusts, some are coming from Europe actually, are using Hong Kong as a trust jurisdiction. We also see a movement of capital and wealth managed holding structures out of Europe into Hong Kong and Asia. Okay, now the other one I would like to talk about is asset management value chain. Our city, Hong Kong, we plays an important role in providing corporate trustee services, covering a wide range of investment structures as well as various trustee administration and fund services, forming an integral part of the asset management value chain in support of the asset management industry for investment, for institutional business as well as for retail investors. So you could see that the fund management value chain, of course, the important part, like the first three sections, are really done by the fund managers, the asset managers. But the investment administration, or in the infrastructure and support, those are very important, especially for fund administration value chain. Now, you see that for trustee, of course, you ensure they're properly safeguarded, protection investor interests. And you could do shareholders administration, transfer agency. So we have middle office, so you have to do your trade support to ensure the security are settled properly. And then you have a fund accounting, valuation, as well as financial reporting. And finally, the custodian. We make sure the settlement are properly settled into the custodian account are safe kept there. As you can see, this value chain shows that fund managers are important players, but the role of the fund administration are also critical in your delivery of asset management products and services. Of course, the sexy part, the glamorous part, and the exciting part go to you, the fund managers. But while the middle and back office, we take all this mundane, boring task, goes to the trustee administrators. So you see, you probably are much more familiar with Luxembourg and Dublin as a fund administration center. Plus, do look at Hong Kong. Do look at Hong Kong. Hong Kong has what it takes to be a fund administration center, because our fund administration is very much an integral part of asset management and wealth management. So we already, as you know, Hong Kong is an Asia world city and a gateway for foreign investors. So we have very strong regulatory framework, multiple regulators to protect investors and also to ensure market integrity. And we have good infrastructure to support fund administration services, such as fund accounting, as I mentioned before, custody, and systems for a wide range of investment products and structures. And we have trust companies present to offer trust services to private trusts and to unit trust funds. So increasing number of fund managers coming to Hong Kong, from China, or from globally to establish presence in Hong Kong and set up funds or re-domicile the offer of offshore funds to Hong Kong to take the opportunity offered by the mutual recognition of funds between Hong Kong and China. So you have a greater need for local trustee and administration expertise. We can help you. And the trust industry is also working with stakeholders to facilitate the planning of pleasant implementation of Shanghai Hong Kong Stock Connect, which offer more flexibility to fund managers when structuring China-related products. Finally, we have the people. Accountants, tax and legal advisors, IT people, experienced and well-trained fund administrations are readily available. So you can count on us to do the necessary, boring, but important things, which while you can concentrate on doing your core competence of fund management. So if you want to know more about the trust industry, I mean, we have a report, the Trust Industry Report, which is the first ever report that was written on about trust industry. I'm more than happy to give you a copy. It's very useful, but if anything, this book will make a very good bedtime reading. So I hope my presentation has not been boring, and to let you know more about the fund administration capabilities of Hong Kong, which has been around for many, many years. Thank you.
So I come last. I know that you've got other things to do, like get to the bar, and I'm going to try in a few minutes and using 3 charts to explain why Hong Kong is the premier private equity center in Asia. So I start off with just a map, and the importance of this map is the private equity is truly hands-on industry. When we're looking for deals, we've got to go out and search for them. When you find a deal, you've got to do due diligence on site at that company. And once you've invested, you've got to spend a lot of time adding value to your portfolio. It is simply impossible to do the private equity job from too far away. And Hong Kong has a magnificent geographical advantage over other centers in Asia. The second chart that I've got here shows the historical development of pools of capital in the region. And what is very clear from this is that China and Hong Kong dominate the historic raising of funds for investment in the region. And if you take the Hong Kong number of 100 billion, a good part of that is actually destined to go into China. So you can see that from a private equity investment process, China has been a really the most important destination. But there are a couple of facts that you need to understand about the $200 billion of China money. The first part of it is that quite a lot of that, which is labeled private equity, is actually the cousin of private equity. That when China was pumping money out into the economy, a lot of people took that money, put it into private equity funds that were pre-IPO investment vehicles, and is probably not a continuing source of capital going forward. And the other aspect of it is that China is not a homogeneous economy. The firms that are investing money within that 200 billion are spread out all over China with a concentration maybe in Shanghai and Beijing, but many, many cities have their own private equity pools. And the purpose of this point is to say that when it comes to the cluster effect of having 400 private equity managers in one city, supported by administrators, banks, lawyers, accountants, tax experts, headhunters, consultants, Hong Kong is way ahead of the rest of the region in having a really fantastic support services in an industry that outsources a lot of its work to experts on a deal-by-deal basis. So my third slide is trying to illuminate a little bit about where some of the future may be for private equity. And if you take the last 20 years, China has been an enormous destination for foreign direct investment into the country that has helped transform China's economy. But a fascinating statistic has just come out that shows that for the first 9 months of 2014, the FDI into China was a decline of 1.5% on the FDI in the same period a year ago, which is quite stunning in an economy that is growing at 7.5% still. And it is in stark contrast to the second block, which is showing that the investment out of China during that same period went up by 21%. And if you extrapolate that number a little bit, you have the conclusion that the amount of money outbound from China could exceed the money going in, which is something that we've not seen before. Now, a speaker earlier this morning made the comment that of China's outbound investment, something like 50% historically has come through Hong Kong. Now, that trend from a private equity perspective is already very noticeable in that we see state-owned enterprise investors setting up Hong Kong vehicles to be their first step towards taking an outbound investment perspective. And we're seeing a bunch of the China private equity firms beginning to set up Hong Kong offices, which are helping their investee companies get outside of China and will actually put some money outside of China and help companies come back into China and exploit that market. So what I'm suggesting here is that for the future, Hong Kong will see another form of business in the private equity space, which is helping the outbound capital of China find nice homes, which implies that there is still a great future to Hong Kong as a private equity center that should remain as the preeminent space in Asia.